Qualcomm dropped 11.5% today. Not in a week, not across a bad earnings season. In a single trading session on May 12th, 2026. That's more than $40 billion in market cap gone in roughly 6 hours. And here's what makes it sting more. The Nasdaq, tracked by Triple Q, was sitting at $707 today, essentially flat to slightly positive on the day. This wasn't a market-wide panic. The selling was surgical, and it was aimed directly at Qualcomm. So what did the market see that triggered this kind of reaction? That's exactly what we're going to break down. To understand why this matters, you need to know what Qualcomm actually is. It's the world's largest fabless chip maker, meaning it designs chips but contracts out the manufacturing, primarily to TSMC. That model has two big revenue engines. First, smartphone baseband processors and modems, which have historically made up roughly 40 to 45% of total revenue. Qualcomm's modems power the cellular connections in billions of phones. Second, Snapdragon processors, the application chips that run Android flagships. On top of both of those, Qualcomm collects licensing royalties on its 5G standard essential patents. Every phone sold with 5G connectivity anywhere in the world is potentially a royalty event for Qualcomm. That's been an extraordinarily durable business, until recently. Here's the structural problem. Apple has been designing its own cellular modems, and by 2026 that program is well underway, publicly confirmed and shipping in select devices. Samsung has been doing the same with its Exynos line. When the two largest smartphone OEMs by revenue start pulling modem design in-house, that doesn't just cut into unit volume. It undercuts the royalty leverage Qualcomm has spent 2 decades building. The concern isn't that modem revenue goes to zero overnight. It's the math of gradual erosion. If modem and licensing revenue slides from roughly 40% of the business down toward 25% over a few years, and if gross margins compress along the way, as Qualcomm has to compete harder on price in remaining markets. Earnings per share can fall 30 to 40%, even if headline revenue stays roughly flat. The stock market is a discounting machine. It doesn't wait for that math to fully play out. It prices it in today. Qualcomm has been pitching its AI pivot hard since at least 2023. The story goes like this. Yes, smartphones are maturing, but edge AI is the next frontier. AI inference running locally on devices, your phone, your car, your laptop, requires a capable neural processing unit. Qualcomm's Snapdragon chips have dedicated AI hardware baked in, and management has argued that makes them the natural platform for on-device AI workloads. They've also pointed to automotive. Snapdragon digital chassis is already designed into vehicles from BMW, Mercedes, and others. And they've been targeting data center AI inference with custom silicon. These are real markets. But the timeline is the problem. Automotive revenue, while growing, hasn't reached a scale that offsets smartphone exposure. And in the data center AI space, Qualcomm is entering a market where NVIDIA, AMD, and increasingly custom silicon from cloud hyperscalers like Google TPUs and Amazon Trainium are already deeply entrenched. Let's talk about the competitive moat, because Qualcomm has one, and it's important to be precise about where it holds and where it's leaking. The standard essential patents on 5G are a genuine barrier. Any device using 5G has to license those patents under FRAND terms: fair, reasonable, and non-discriminatory. Qualcomm has defended that position in court repeatedly and largely won. That licensing stream through its QTL segment has high margins. We're talking gross margins well above the corporate average. The issue is that legal moats erode at the edges. Regulators in Europe and South Korea have previously challenged Qualcomm's licensing practices. And as 6G standards begin to be set, a process that's now active at standards bodies, Qualcomm will have to fight to maintain its patent position all over again, competing against Ericsson, Nokia, Huawei, and others who are filing heavily. The moat isn't gone, but it requires constant, expensive defense. Zoom out to the broader market for a second, because context matters here. Bitcoin is trading around $80,478 today. SPY is at $738. The VIX, the market's fear gauge, is sitting at roughly 18, which is elevated but not panicked. In other words, this isn't a macro risk-off environment driving Qualcomm down. The broad market is holding together. That makes the Qualcomm move more telling, not less. When a stock drops 11.5% in a calm market, it means the selling is about the company's specific forward earnings picture, not about someone liquidating everything because they are scared of a recession. Institutional investors are making a deliberate call that Qualcomm's earnings trajectory is worse than the stock price was reflecting yesterday. To be fair to the other side of the argument, because there is one, Qualcomm has several things going for it. The automotive pipeline is real and growing. Snapdragon Digital Chassis has multi-year design win cycles, which means revenue locked in years in advance. IoT and industrial edge computing are genuine growth categories. And Qualcomm's chip engineering talent is legitimately world-class. They've repeatedly out-executed on performance per watt benchmarks against ARM-based competitors. There's also a valuation argument. After an 11.5% drop, Qualcomm's price-to-earnings multiple compresses, which could attract value-oriented buyers who think the bear case is already priced in. None of that makes the structural headwinds disappear, but it does mean this isn't a simple story of a company in irreversible decline. Going forward, there are three numbers that will tell you whether the bear thesis is playing out or stalling. First, QTL revenue as a percentage of total. If that licensing segment keeps shrinking as a share of the mix, the high-margin royalty engine is genuinely weakening. Second, automotive revenue growth rate quarter over quarter. If Qualcomm's pivot is real, that line has to accelerate meaningfully over the next 4 to 6 quarters. Third, gross margin at the QCT segment, which is the chip business. If Qualcomm is being forced to compete on price to hold smartphone market share, you'll see it in QCT margins before you see it in headlines. Those are the data points that matter, and they'll all be in the next earnings release. Watch the segment breakdown carefully, not just the top-line beat or miss. Here's the bottom line. Qualcomm dropping 11.5% in a single session while the broader market holds steady is not noise. It's the market repricing the probability that the smartphone modem era, which built Qualcomm into a $200 plus billion company, is entering a structural decline faster than the AI and automotive pivot can compensate. The patents are real, the engineering is real, but the window for the pivot to prove itself is narrowing. And today's move suggests a significant number of institutional investors decided the old price didn't reflect that risk. Whether they're right will show up in the next 2 or 3 earnings cycles. Until then, Qualcomm is a company in genuine transition, with all the uncertainty that entails. That's it for today. If you found this useful, subscribe. We do this for every major market mover. See you next time.